Jan Kaufman here. August 4th, 2021. About 17 minutes left to the bell. The spoos are down 14 handles. And people, we are trapped inside of a range that is literally going to define this marketplace. Let's get to work on this evening's video talking, well, expressly about that. First and foremost, let's go ahead and actually define what that range happens to be. For that, we're actually going to open up into an S&P futures chart. I'm looking at a 30-day 1 hour, but I've zoomed in just a little bit, and I've zoomed in simply because we jumped into this incredibly tight range. Okay, and you can look back a little bit in here in time and follow my cursor on the screen back all the way on July 23rd, which was a Friday, is when we actually jumped into the range. Here we are again, August 4th, the exact same range. So to define the range, let's actually bring up a little bit more of a fancy drawing tool. Okay, let's go for it here. The lower end of the range is roughly 43.70. Upper edge of the range is 44.20. It's a 50 handle S&P point range. Now, first of all, that's fairly shocking, just given the fact that 50 points, but the expected move, for instance, this week is about $65. The expectation of movement in the previous week was roughly speaking 57. We can't get out of a 50-point range literally from high to low. From a probability perspective, this is wild. Now, the reason I say that this is the range that's literally going to define the marketplace, okay, a lot of people are going to try to really dissect this marketplace, and you have tendency to apply a lot of technicals to levels like this. And I want you to, for just a moment, push all of that aside. I know people look at charts and you look at your MACD, your Fibonacci, your Bollinger Band, but they're missing the bigger picture here. And when I talk about, the range that's going to define the marketplace, it has everything to do with accumulation, okay, of risk. And you can see the accumulation of risk right now. And when I say you can see it, okay, you can literally see it, which I'll show you here in a moment. But there's another aspect that people kind of fail to see, and that is the institutional, traders, proprietary traders, market-making firms, they all see it, and they're actually backing positions down quite substantially. Like liquidity right now is dead. If you actually look at the S&P futures, they haven't even done 900,000 contracts. We'll look at that in a moment too. So what's the beef with the marketplace? Like, what's going on? The aspect that most people forget about that is not visible here in the chart, okay, is going to be, for example, open interest. Okay, accumulation of risk often comes in the option markets. It's in the spiders, it's in the SPX, in the S&P options and futures. And what's occurring right now is anytime that you stay range bound. Now, we have been range bound in the past. I mean, I talked about something, very significant in the past that ended up with the marketplace blowing higher. It wasn't too long ago, but this is completely unique in respect to the fact that how tight the range is for, you're into the 8th, maybe 9th trading session. We just cannot get outside of the range. And this 50-point range, it is unique. Okay, again, it's not unique to be trapped in a range, but a 50-point range is unique for this period of time, because what's going on in here is, volumes may be down in option markets, but we're still doing right around the past couple of days, we've been doing about 32 to 33 million contracts a day. You realize that open interest just starts to accumulate and starts to accumulate. Okay, and we just grow with larger and larger risk. Okay, and this ends with, well, looks like a bit of a crescendo here, and that's exactly the way it is going to end. For the most part, one of the things that I really want to point out, I know you can't even see the chart in here, but one of the things I want to point out, it does not matter whether we're at the upper or lower edge of the range. Gamma risk is going to grab a hold of this thing, and when we do blow, okay, we can explode higher or explode lower. Now, obviously, everybody wants to know, is there anything in the marketplace that displays, if you will, are we going to explode higher or lower? I'm going to try to, again, kind of dissect that a bit for you. And again, I wanted to show you the volume here. Look at that, 13 minutes to go into the day. We haven't even done 900,000 contracts. And if you're looking at this, people are going, well, that's because the marketplace is boring. That's because it's boring, really? Because we've had a decent range. I mean, we've had over a 20-point range inside of the spoos. I've seen a lot more boring summer days than that. Okay. The bottom line is no one here wants to commit to risk. And that's one of the things that makes this so dangerous. And that's one of the things that you got to bring to your attention, is that the range defines the marketplace because it simply means here comes the binary nature of the marketplace. And that binary nature, that's not exactly, by the way, a happy thing to say that this is about to be, a wild binary move, but that's exactly what this is going to break down to. Okay, and let's not, hedge around anything. When I say a binary move, listen, it doesn't matter if it's your upper edge or lower edge. When we blow through, we're going to explode higher and or explode lower, and it's because all of this risk that's accumulating. So you get all of this gamma risk. And what gamma risk basically breaks down to is delta risk. When we go up, okay, traders are actually going to have to hedge with the dynamic of the marketplace. So as soon as we break, that like 44.20, we explode higher. If we break down just below that 43.70, we get absolutely wicked and we break lower. And I have to tell you, okay, when push comes to shove, if you said like, hey, when do you think you're going to break the range? Tomorrow, possibly Friday, maybe the jobs number really sparks something. I mean, the ADP report came out today, and not a lot of people necessarily look at the ADP report, but the ADP report, which literally comes out, and I'll zoom in on it for a second, comes out at 5:15. That rocked the market. It wasn't so much the S&Ps as you saw the volatility that played out following the ADP report was very specific. It actually spiked the bonds and the bonds cratered after that. There was also some significant volatility today specific to the dollar, okay, which in turn kind of rocked gold and again kind of moved the bonds. So there was some volatility inside of today's trade, but again, no one's willing to want to commit, okay, to anything at this point until we actually crack these S&Ps. So if you want, like, and you can dig into the marketplace as much as you want. So is the marketplace like leaning like it's going to break higher or it's going to break lower? The only thing I think that would be insightful here, it's not so much looking at the S&Ps. It's not even so much looking at the volatility. Okay, I mean, it's unusual today. The S&Ps are down 14, but the volatility is basically down on the day. That's unusual. It is. Okay, that's not saying bullish or bearish necessarily. The one aspect that kind of resonates with me has to be the bonds, though. The bonds make me nervous because the bonds, they're ready to break out to the upside. In fact, they touched into the literally, right up against that 167. In fact, if you take a look at the bonds, that high tick 167 bonds. That's the only thing that I think causes pressure in the marketplace in the near term to the downside, because the bonds break out, it should cave the financials. The financials have been incredibly resilient. You just can't stress that enough, how resilient these financials have been in the face of adversity. And you want adversity? Okay, can you imagine the financials have been absolutely unequivocally flat, and they've been flat since this break lower, which was mid-June, but they've been flat. But look at the interest rate environment. Okay, the interest rate environment, it's falling off the edge of a cliff over here. I mean, you wouldn't even ski down that. It's so steep. But that has not, with falling interest rates, has not impacted the financials. And again, if you're looking for one aspect that kind of just resonates with me, I don't have a feel right now for tech. I don't think anybody does. Okay, I mean, simply put, they came out, some of them made earnings, some of them missed earnings. We laughed, we cried. All of a sudden, you want to buy Facebook. Okay, again, there's no feel per se to tech, but financials, I think, are like literally gripping on to this 36 half level like it was grim death. And if those bonds do break to the upside, I just think it's going to snap the back of the financials. You snap the back of the financials, then you're going to literally take the footing out from under the S&Ps. Why? The financials will break. Okay, energy will break, and energy is actually a little bit of on the downswing. It'll actually undermine the S&Ps, and eventually we'll see higher degrees of correlation. I mean, look at this. You got a marketplace that's down 13 handles, which is nothing. Like, you have to look at this day as absolutely nothing. We're just back in the range. The advanced decline line is horrific. It's just absolutely horrific over here. Volatility, though, it's just shrugging its shoulders like whatever. But the bonds are really, again, the only standout. That's what to look for here. I mean, again, I believe if these S&Ps are going to break this range, and it's going to be Thursday or Friday, okay, the most likely scenario is that the bonds rock to the upside. The bonds rock. Again, they crush the financials, takes what? The energy sector with it, and there go the S&Ps. Hopefully that is a kind of a clear and concise picture of what's going on inside of the marketplace right now. Remember, this range, it's binary. Okay, it's dangerous, and you should respect it in terms of allocation. Okay, this is where professional traders have tendency to kind of pare back some of the allocations. If you're not comfortable in deciphering, if this thing's going to the upside or the downside, That's why a lot of professional traders, they're scaling back. They're not trading a lot of contract size. You can see it, okay, in the nightly volume, which I said was about 33 million in terms of the option side of the business, but even side of the S&Ps, okay, there's no commitment to trade at these levels. Keep that in mind because a whole lot's going to change when we do break this defining range. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.